September 15, 2008. Lehman Brothers, one of the most powerful banks on earth, 158 years old, survived the Great Depression, 2 world wars, and the dot-com bust, files for bankruptcy. Overnight gone, $600 billion in assets vaporized. Stock markets round the world go into freefall. Credit cards stop working. Companies can't make payroll, and within weeks, $10 trillion in household wealth, pensions, savings, retirement funds, just disappears. But here's the kicker: nobody could say they didn't see it coming, because almost everyone did. They just didn't want to stop making money long enough to care. This is the story of the greatest financial disaster since the Great Depression, and it started with something as simple as a house. Picture this. It's 2000 to America is still shaken from 9/11s. The dot-com bubble just popped. The stock market is a disaster zone. People are nervous. And Washington knows it. So the government does what governments do. It finds a new dream to sell. President George W. Bush calls it the ownership society. The pitch is elegant, simple. Almost beautiful. Homeownership is the American dream. Every American deserves a piece of it. Let's make it happen. And to fund the dream, Alan Greenspan, the all-powerful chairman of the Federal Reserve, a man so respected that Congress basically treated him like a financial deity, slashes interest rates to historic lows. We're talking 1% in 2003. The federal funds rate hits 1%, the lowest it had been in 45 years. Translation: borrowing money was basically free. Now, when borrowing is cheap, people buy houses, lots of houses. And when lots of people buy houses, prices go up. And when prices go up, more people want to buy houses, and more people borrow, and prices go up more. You see where this is going, but wait. Who's actually lending all this money? Banks, sure, but also a new breed of lender: mortgage brokers. These are salespeople, essentially, paid on commission. Their job is simple: get people into mortgages, as many as possible. The bigger, the better. And here's where the first crack appears in the foundation. Because these brokers don't actually care if you can pay back the loan. They're not keeping it. They're selling it to someone else, and that someone else they're selling it to. The mortgage is leaving the building, and with it goes any reason for anyone to ask, can this person actually afford this house? Cue the upbeat music, because we're just getting started. Okay, this is where it gets a little complicated. But stick with me, I'm going to explain it like you're 5. A financially anxious 5-year-old. But still, imagine you're a bank. You give someone a mortgage. Now, every month, that person sends you a check for 30 years. That's great. But there's a problem. Your money is tied up for 30 years. You can't lend it to anyone else. So Wall Street invents a solution. They call it securitization. Big word, simple idea. You bundle thousands of mortgages together into one big package. Then you slice that package into pieces, called tranches, and sell those pieces to investors. The investors get a monthly return. You get your money back immediately. Everyone's happy. These packages are called mortgage-backed securities. MBS, translation, a product made of mortgages, backed by houses, sold to investors who are betting homeowners will keep paying. But Wall Street doesn't stop there, because Wall Street never stops there. They take the riskiest slices of these mortgage bundles, the ones nobody wants, and they bundle those together into a new product called a collateralized debt obligation. CDO, translation, a bundle of bundles, a financial turducken. And here's where it gets genuinely insane. These CDOs are rated by agencies like Moody's, and Standard and Poor's rating agencies are supposed to be independent referees. They tell investors how risky a product is. Triple A means safe as US government bonds. Triple B means riskier. Junk means don't touch it. Guess what? rating most of these CDOs got. AAA, the same rating as U.S. Treasury bonds products stuffed with risky mortgages, given to people with no income verification, no down payment, sometimes no job, rated the same as the full faith and credit of the United States government. How? Because the rating agencies were paid by the very banks whose products they were rating. You want a AAA. Here's what structure you need. The banks built products that passed the test. The agencies rubber-stamped them and everyone got paid. It gets worse. Investors could now buy something called a credit default swap. Think of it as insurance on a mortgage product. You don't own the mortgage. You just bet that it'll fail. And the seller of that insurance, companies like AIG, collected premiums assuming the mortgages would never all fail at once, because house prices never go down right. Meanwhile, back on Main Street, the standards for getting a mortgage are dissolving in real time. I'd like to apply for a loan, great income. $60,000 a year, excellent, here's $600,000. These became known as ninja loans. No income, no job, no assets, approved. We also got the LIR loan, where you just stated your income and nobody checked. We got adjustable rate mortgages with teaser rates. Pay 2% for 2 years. Then surprise, it jumps to 8%, and none of this mattered to the mortgage broker, the bank, or Wall Street, because by the time the bill came due, the mortgage had been sold, sliced, repackaged, rated AAA, and shipped to a pension fund in Norway. In 2006 alone, $600 billion worth of subprime mortgages were issued. Subprime means loans to borrowers who are already considered risky. $600 billion. The machine was running hot. Housing prices were up 124% since 1997. Everyone who owned a house felt rich. Everyone who didn't was scrambling to get in before it was too late. But beneath the buzz, beneath the cocktail party, chatter about property values and investment strategies, one number was quietly getting worse: default rates. The percentage of homeowners who couldn't make their payments. It was rising slowly at first, then faster, and nobody wanted to talk about it. Housing prices peak, then they do something they hadn't done nationally since the 1930s. They go down, not dramatically, not at first, just a little, enough that the adjustable rate borrowers who are banking on refinancing, using their home's rising value to get a better deal, suddenly can't. Because the value isn't rising anymore. Payments reset. People default. More houses hit the market, prices fall further. More defaults. More houses, lower prices. This is what economists call a feedback loop. Everyone else calls it a disaster. March 2007, Bear Stearns, one of Wall Street's biggest investment banks, announces that 2 of its hedge funds, stuffed with mortgage-backed securities, are in trouble. By June, they've lost nearly everything. Bear tries to bail them out. It costs $32 billion, and it isn't enough. First domino. 2008 rolls in and the cracks become craters. February, mortgage lender Countrywide Financial, at one point responsible for 1 in 5 American mortgages, is absorbed by Bank of America in a fire sale. March, Bear Stearns itself collapses. The Federal Reserve ranges the rescue, brokering a sale to J.P. Morgan for $2 a share. $2 a stock that traded above $170 a year earlier. Second domino, summer 2008. Fannie Mae and Freddie Mac, to government-sponsored companies that owned or guaranteed half of all American mortgages, are taken over by the U.S. government, nationalized in America. The land of the free market the government just nationalized to mortgage giants. Third domino. And then, September 15, 2008, Lehman Brothers. Lehman had $600 billion in assets and mountains of mortgage-backed securities on its books. It had been looking for a buyer. Nobody came. The government having just rescued Bear Stearns and taken over Fannie and Freddie, decided this time they'd let it fail. That decision sent shockwaves through every financial institution on earth. Because if Lehman could fail, anyone could fail. And nobody knew who was holding what toxic debt. Credit markets froze. Banks stopped lending to each other. The commercial paper market, where companies borrow overnight cash to make payroll, locked up AIG, which had sold for $140 billion worth of those credit default swaps insuring mortgage products, was hours from collapse. The government bailed it out with $85 billion within 2 weeks. Goldman Sachs and Morgan Stanley, two of the most powerful names in finance, converted to regular commercial banks just to access Federal Reserve emergency funding. The entire architecture of global finance was cracking, and somewhere in Ohio, a nurse named Sandra opened a letter saying her pension fund had lost 40% of its value. Here's the part that'll make your blood pressure spike. October 2008, Congress passes TARP, the Troubled Asset Relief Program. $700 billion authorized by the government to buy up the toxic assets strangling the financial system. Translation is $700 billion check, written by American taxpayers, handed to the banks that caused the crisis. The banks said, "Thank you," then paid their executives bonuses. By the time the recession officially ended in mid-2009, the damage was almost incomprehensible. $10 trillion in household wealth. Wiped out. 8 million Americans lost their jobs. Nearly 4 million homes were foreclosed. The unemployment rate hit 10%. In 2009, the U.S. economy contracted by 25%. Its worst year since 1946. Meanwhile, on Wall Street, the executives who built the machine largely kept their fortunes. Of all the major players involved in creating and selling these products, fewer than a handful went to prison. One prominent banker from Credit Suisse, some low-level mortgage fraud cases. But the architects of the machine, most walked away, find it most with their wealth intact. The government did respond in 2010. President Obama signed the Dodd-Frank Act, the biggest financial regulatory overhaul since the Great Depression. It created new rules around bank capital requirements, consumer protection and derivatives trading. It established the Consumer Financial Protection Bureau. It tried to make sure this couldn't happen again. Whether it worked is debated loudly. Some of the most important Dodd-Frank provisions were rolled back in 2018. The banks kept lobbying. The regulations kept bending, and today, in 2024, household debt in America is at an all-time high. Commercial real estate is wobbling. A new wave of exotic financial products is growing in the shadows of the banking system. The rating agencies are still paid by the firms whose products they rate. Some things change after a crisis, and some things just wait for the next one. The 2008 financial crisis wasn't a natural disaster. It wasn't a lightning bolt from the sky. It was a system built by intelligent people, making individually rational decisions. That created something collectively catastrophic. Every person in the chain, the broker, the banker, the rating analyst, the regulator, had reasons to look the other way. And they did so. Here's the question to sit with. When the incentives reward short-term profit and somebody else pays the long-term cost, what actually changes?